Now, let's break down those three critical elements that I mentioned just a second ago in more depth. First, the revenue replacement strategy. Here's what that looks like. We're going to expand the sales tax base. What I mean by that is we're going to broaden taxable categories to include things like digital products, luxury services, and short-term rentals. By doing so, it's estimated that we're going to bring in between $15 and $20 billion annually. Okay? Now, we need to maintain the current sales tax rate to avoid regressive impact, but we expand the tax base. Okay? Furthermore, we need to tap into natural resource royalties, doing things like applying severance taxes or royalties to things like oil, gas, lithium, and geothermal extraction. The estimated revenue from that is between $5 to $10 billion annually. And this also aligns with growing national and global demand for critical minerals and clean energy sources. Furthermore, we need to monetize state-owned assets. And what I mean by that is we need to lease or develop underutilized public lands for housing and commercial use. The estimated revenue from that is between $2 and $5 billion. Beyond that, we need to consider more tourism and infrastructure fees. We need to target high traffic sectors like hotel stays, rental cars, air travel, with modest surcharges. The estimated revenue from that is $2 to $4 billion annually. Additionally, we need to consider fees for high volume businesses and technology corridor fees. By introducing logistics and data processing fees for things like e-commerce warehouses, AI firms, and server farms, the estimated revenue from that is between $3 and $6 billion annually. Additionally, we need new funding mechanisms. We should launch a blockchain-enabled lottery system and tax incentivized what I call California comeback bonds, which would bring in approximately $1 to $2 billion a year annually.